All right, welcome everybody to Daily Mortgage Rates Live with the Mortgage Calculator. We're going to wait just a minute to get started as we always do every morning. Give everybody a chance to jump on and wait till we go live on all the different platforms. So just hang tight with us. And we put up the chat. Everybody tuning in, if you want to drop a comment there in the chat as you tune in, feel free to do so. Good morning to everyone. Just going to wait 1 minute here to get started. Good morning, everybody dropping comments in the chat. Julio, Mark, Matthew. Good morning, everyone. And everybody tuning in, remember we do this every weekday at 11 a.m. Eastern. Go through the rates, go through a deep dive into a different topic. So happy to have you all with us. And we're just waiting a minute to go live on all of the different platforms. But feel free to drop a comment there in the chat. All right. It looks like we are live on all of the different platforms, so we can go ahead and get started here. We'll go ahead and take the chat off the screen, and then we can get into it. All right, welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We do this show, Daily Mortgage Rates Live, every weekday at 11 a.m. Eastern, where we go through the live rates of some different programs, and then we do a deep dive into a different topic every day. Now, today's topic is going to be zero cash out seasoning refis. And so we're going to have Jose talk a little bit about that. Jose is our sales manager with 27 years of experience. But before we do that, like we do every day, we'll go ahead and pull up our pricing tool to check out the actual rates for today and see what the market is like compared to yesterday. So, Nick, why don't we go ahead and pull up our pricing tool there and check out what's going on this morning?
All right. Lots of news going out, obviously, so definitely going to be interesting. Let me go ahead and change my screens, and we'll pull up the pricing tool. So, as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. If you'd like a full loan estimate, we have over 300 licensed loan officers, and we can do primary second homes in 22 states. And we can do our DSCR business purpose loans in 44 states, so pretty much all over the US. If you'd like a full breakdown, please get with one of our team members. We're going to use our pricer today to check out the general programs and the APRs for the rates today. And it is May 2nd, just after 11 a.m. There is a Fed meeting that's just starting, so obviously lots of volatility in the rates lately, so it's going to affect us a little bit here. We'll probably see some interesting stuff right now, and then later today we'll probably see some reactions as well. But let's go ahead and set up a general scenario so we can compare across our basic programs. So we'll set our scenario up to a $400,000 loan amount as we do every day. We'll set our LTV to 80% loan to value, 20% down payment. We'll set the desired price to 99. That means we're going to ask the computer to find the best rate at one discount point in cost. Most of our customers, since the rates are a little higher than most people would like, ask to buy down the rate a little bit. So this is our average request. And we're going to go through our different loan types, conforming, conventional. Then we'll check out our FHA rates this morning. And then we'll go into our expanded guidelines, aka non-QM, where we have over 5,000 additional loan programs that use alternative income documentation. We do have VA loans available. That's only for our eligible veterans. So if you are eligible, we appreciate your service and would be happy to quote it, but not everybody's eligible, so we don't do that live. And same with USDA, that's only for properties in a rural eligible area. If you do happen to be shopping in those areas, we'd be happy to quote it, but not everybody is, so we won't do that live either. So let's start with our conforming conventional. We'll do a purchase, 30-year fixed loans, pretty standard loan, primary occupancy, single family home, 1 unit, state of Florida, county Miami-Dade. And for all of our estimates today, we'll use an estimated FICO score of 760 and an estimated debt to income ratio here of 40%. So with these basic setups, let's go ahead and check out the rates this morning. So it's actually the same as yesterday. Again, we're probably going to see some repricing here later today after these big announcements in the market. So right now it looks the same as yesterday. Best option the computer finds is a 6.5 rate for one discount point in cost and a final APR of 6.676, which I believe is the exact same it was yesterday, actually. So great option here for our borrowers that want to go conventional. And let's go ahead and make sure we always compare the APR across our different programs. So let's go ahead and compare to our FHA programs. Most times if a customer doesn't qualify for conventional, the next option we would approach is typically FHA. FHA does allow a little more leniency on credit guidelines and also has a higher debt to income ratio we can use. But all we're simply going to do is set up the same exact scenario. We're only changing FHA here. Everything else will stay exactly the same. So we can quickly compare conventional to FHA for this exact scenario. This also looks about the same as it was yesterday, so not much movement yet this morning. We have a 5.75 rate for one discount point in cost and a final, actually, at the bottom here, there's an option that's a little bit better here. 5.75 rate for 0.875 discount points in cost and a little bit lower final APR there, 6.348. So remember, we compare APRs. That will take all of our costs into account because FHA does have upfront and yearly mortgage insurance that's paid monthly. So that's included in that cost. So for 6.348, it's actually slightly lower than our conventional option was. So definitely recommend our borrowers that are shopping right now for this scenario or similar, check out both options because in this case, FHA is actually a tad bit cheaper. Now, if our customer has any trouble qualifying for FHA or conventional, many other banks or lenders don't have other options, but that's where we love to come in and quote our expanded guidelines, aka non-QM options. So we'll set everything else up the same as our other scenarios, but we have a new option that pops up with non-QM, and that's our income verification options. So let me scroll down. So full doc is what we do for FHA and conventional. That's 2 years of tax returns, what most people are used to. So many times when we select non-QM, we're going to pick a different option, which is the benefit here. So 1 year alt doc or 2 year alt doc are general programs. We have our asset related programs, which doesn't actually require employment. We're just using a large asset. Have our business bank statement programs are popular. Investor DSCR programs for investment properties. Personal bank statements is our most popular program by far. We also have VOE, 1099, P&L, all these different options. But the most popular option that we'll do for our demo today is a personal bank statement, 12-month option. And that's going to be for our self-employed borrowers. Many times our self-employed borrowers, when they submit 2 years of tax returns, have various write-offs and don't qualify at all or don't qualify for as much income as they wish for the house they want to purchase. So in this case, instead of using 2 years of tax returns, we're simply going to use 12 months of bank statements, the last 12 bank statements, to determine a debt to income ratio using those bank statements and cash in the bank rather than the tax returns. So most of our self-employed borrowers either qualify where they would not qualify or qualify for much more income and therefore a much larger loan amount. Now, let's go ahead and check out the rates this morning for our bank statement programs. And remember, these non-QM programs will be a little bit higher rate, but they're great solutions for our borrowers who would otherwise not qualify. So the best option the computer found here at the top, 7.125 rate for one discount point in cost for a final APR of 7.205. So remember, the conventional was 6.6 something, the FHA was 6.3 something, and here we have a bank statement option, very comparable, just a little bit higher there at 7.2 APR. So great options for our borrowers who would otherwise not be able to get a home, can now get the home of their dreams. Notice there's a ton of different bank statement options here with various rate and costs. Some of these things may allow things like credit events, like foreclosures and bankruptcies. That's the beautiful thing about non-QM is there's hundreds of different programs with different variations. So please get with our team. They'll navigate which one of these options works best for you. Now, before we pass it off to Jose for a deep dive, we always want to go ahead and do a live pricing example on investment properties. We love to work with investors here at the Mortgage Calculator. And we're going to set up our final two demos with the same scenario as before, 80% loan to value, 20% down payment. And this time we're going to do investment properties. We're going to compare conforming conventional to our expanded guidelines non-QM options. And that's because FHA, VA, USDA are not eligible for investment properties. So we'll simply compare these two options. So we'll start with conforming. We're going to keep everything else the same as all our other demos that we did today. The only thing we changed was investment property. So let's check out the rates for conventional investment properties. So as we go over every morning, there are additional costs that have been added to investment properties for conventional loans. So the best option the computer found here is a 7.25 rate for 3.25 discount points and costs and a final APR of 7.501. So good options for our borrowers that qualify for conventional, but many times our investors that have other investments would rather deploy these costs, these large costs that they've added to other projects. So many of our investors ask to go higher in the rate. So even if we cruise down here, there's not a lot of options that are, this is a portfolio option, it's not quite conventional. Right here, decent option, 7.5 for 2.75 points, but we love to present our non-QM options, which solve this problem for our borrowers. So for our last demo, let's go ahead and check out our investment property. Set this back to 80% loan to value. And we'll check out our non-QM investment property options. So we have two new boxes that popped up. First, our income verification option. As I mentioned before, the most popular program for investment properties is going to be our DSCR option. That's because it doesn't require any employment or income from the borrower. We're simply going to use the estimated rental income from the property to determine if that covers the expenses of this mortgage we're proposing, the PITIA of the mortgage. If the gross rents can cover our expenses and it cash flows, that is a ratio of 1.00 or greater. There's a ton of loan programs for that. Even if the property doesn't quite cash flow and the estimated rents don't quite cover the mortgage expenses that we have, that's a ratio less than 1.00, and we have options for that as well. So tons of different options in DSCR. For our demo today, though, I'll go ahead and delete this so we see all the different scenarios. And for all of our non-QM investment properties, we always have to set a prepayment penalty. That is standard. We always set 3 years, which is standard for these programs. If we desire, we can select 0. That will limit the amount of loan programs we have and cost more money. And we can also choose 5 years, which not all programs allow 5 years. It will save a little bit of money in some cases, but we always choose 3 years so we can see the largest amount of options here. So with these basic settings, let's check out our DSCR rates this morning. A little bit higher than yesterday there. So the best option we can see here, 6.25 rate for 0.725 discount points. So we're solving our problem for our investor there, a little bit higher rate, but less discount points, which allows them to deploy their cash elsewhere. And a final APR of 7.696. Very comparable there. Remember, conventional was 7.5. Now we have DSCR, not only non-QM, but a DSCR non-QM, which doesn't require any employment or income from the borrower for relatively the same cost. So great options here today. Investors out there, definitely recommend check out the DSCR options. And you'll see we have hundreds of different options here with different prepayment penalties, different DSCR ratios. Some of these may allow things like short-term rental income and other variations. So please get with our team. They'll find which one of these works best for you. Now, let me go ahead and switch my screen again, and we'll get into our detailed topic for today. So for those of you that joined us earlier, today Jose is going to talk about something that's kind of interesting, kind of a weird way to word it here too. Zero cash out seasoning refinance. Basically what we're looking to do here is find a solution for our investors out there typically that are buying properties that are possibly distressed or some other situation where they're paying cash or some other kind of hard money and typically would like to get a more regular loan, a cash out loan, and possibly cash out using the new value because they've obviously scored a deal in some way, shape, or form. So very popular request, especially from our investors out there doing projects. They luck out on a deal, they secure the deal. However they secure the deal is obviously not the end financing goal that they're looking for. So they're coming to us to look for an end loan for whatever they've gotten into, and obviously cash out if they're able to. So, Jose, if you're ready to go, let's go ahead and have you take over.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Yes, when we're talking about seasoning here, we're not talking about the seasoning on your steaks. We're talking about the seasoning on title that is normally required in order to be able to capture the market value for the property instead of what is usually the case when you don't have enough seasoning, instead of the purchase price plus any repairs you may have done to the property. That's usually the value that you get from an appraisal, from guidelines, let's say, when you are doing a cash out refinance on a property that you have owned for less than the necessary required seasoning. Most of the time, you're going to find that seasoning to be either 12 months or 6 months. And in some cases, you will find that there's no seasoning required when you have completed extensive renovation to the property. Right. Well, the examples that we're giving here, we do not have any of those requirements to prove that you have completed extensive renovations to the property. If it's a cash out refi, you only have to be on title at the time of application. And if it's a purchase, it's a purchase. And we're not talking about cash out on a purchase, but there is a flipping uh, situation that we all have to be aware of, which is why I'm throwing it in with these examples. Because if a buyer is purchasing a property that the seller has been on title for less than 6 months, that would be considered a flip. And in most cases, it will result in the same restrictions being applied to your loan that would be if you are dealing with an option that has restrictions on cash out refinance without seasoning. They're going to use the purchase price plus any renovations or upgrades or repairs that were completed to the property as the market value. But to remind you all, that is not the case in the examples that I'm showing you here today. These examples, we are going to be able to capture the full market value. So my first example here is for a purchase. And for these examples, we are using our business purpose loans, which are the ones that do not have any of the restrictions that would normally be in place for a primary or second home, a TRID loan. So the business purpose loans do give us more flexibility, and this is one of the good ones for this particular product. So in this scenario, we have a 20% down purchase of a flipped property, right? So no second appraisal needed, and this is the options we get. We can go as low on cost as a $600 lender credit at a 9% rate, and you can buy it down to 7.5%, and that's going to be at a cost just under 3 points for this 20% down option.
So that's now, for properties that we're purchasing that don't have enough seasoning. So this is a seasoning
issue, correct?
Issue on a purchase.
Gotcha. Correct, which does happen
more often than you think, right?
Yes. Oh man, there's all of those flippers out there that we're doing loans for. They're going to either hold the property as a rental, in which case they're gonna refinance out of that flip loan into usually a DSCR, or using usually this strategy right here, or they're going to sell the property, in which case they're going to be selling a flip. So we have to make sure that we give them the proper consultation. So for our cash out refi, here we have 75% LTV, which is the maximum LTV for this product. And as I say here in the notes, close today and refi tomorrow. As long as you're on title, at application, as long as the current borrower is on title. So if they want to take title in an LLC, but for whatever reason they took title to the purchase in their personal name, they would have to do a quick claim deed to the LLC prior to the loan application. That's critical because that's the only catch here. They have to be on title at loan application. So you're looking at, again, it's pretty much same rates. You're looking at 9%. Now, this is 75% LTV, not the purchase, but it's the same rates, 9%, giving you a little bit of a lender credit. And you can buy it down to 7.5% at a little bit above 2 points on the cost there. So that's your 75% LTV cash out refi. So let's go to another little option here. We're going to go to our 4 unit, which I always like to throw in there, our 4 unit purchase to see where it fits into the mix. And as you can see, great news here, there are no adjustments to LTV nor pricing for a 4 unit property. Same 1 to 4 unit, same LTV. So that is great news. That is for the purchase. And then this is for our 4 unit cash out refi, 75% LTV. You'll notice same rates as on the 1 unit. So now I just wanted to throw a little bit more context to our 20% down quote. So just give you an idea of what would the rates be if the borrower put down a little extra down payment. So here they're putting 5% down payment more, and you see that the rate drops. The rate offering a lender credit drops from 9% to 8.75%, and the lowest rate drops to 7.375. And in our last example, we're showing you a 70% LTV as opposed to 75% LTV cash out. And again, you see in this case, the rate did drop to 8.625 with a little bit of a lender credit, and your lowest rate is 7.25, and that is just under 3 points for that 7.25. So you do see that it does get a little bit better pricing at the lower LTV. So you all are aware this is something that is very exciting to all the flippers out there, because all the flippers out there do not want to wait 6 months, do not definitely want to wait 12 months before they can get their money back. They need that money back in circulation so that they can buy more properties and repeat the whole process again. And then we'll be there to offer them the fixed flip loan for the rehab, and then we refinance them out of the fixed flip loan into one of these DSCR loans without a seasoning requirement, because typically those fixed flip projects are, I mean, unless you're changing, adding bedrooms, bathrooms, and all that, it's usually kitchen, renovate kitchens, bathrooms, floors, some painting, exterior, and you're out of there, and you're looking at 2-3 months. And then they want to put the property on the market, they want to get it under contract, and they want to be able to sell it or refinance it. So this is an amazing option for them.
So to be clear, the seasoning requirement for conventional loans is 12 months, correct?
Yes, sir. 12 months to obtain the full market value. They will let you do a cash out at 6 months, but with restrictions on the valuation. They're not going to give you full market value until 12 months and 1 day.
So that's why we saw no conventional quotes, because they don't exist, right? So we're solving problems here with our DSCR loans, which are great problem solvers, our non-QM problem solvers, because remember, all conventional loans have to follow the rules that Jose just outlined. Doesn't look like we have any questions for today, specific to today. If anybody has any questions, let us know. But Kyle, I guess why don't you sign us off if we're ready to go?
Yeah, absolutely. A couple questions from our team members there. I emailed you all separately about that. But yes, great programs here. And as you can see, this is something that you need to be walked through, right? You need a loan consultant to do so. So at the Mortgage Calculator, our loan officers are not just loan officers that do conventional loans like most do. Our loan officers are consultants that can walk you through the thousands of non-QM products we have, which is everything from conventional FHA, USDA, which we do, as well as VA, but all the way to these non-QM programs, such as the bank statement programs Nick went over, DSCR, these programs that Jose went over, and all the way to the fix and flip commercial. We do everything in between. So to be connected with one of our loan officers, visit us at themortgagecalculator.com. We can connect you with the loan officer consultant that can consult you through this process. Now, we do this show at 11 a.m. Eastern every weekday where we show you how the rates go up and down, and then we do a deep dive into a different topic like we did today on the zero seasoning cash out refis. So thank you, everybody, for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see everybody again tomorrow at 11 a.m. Eastern for the next episode of Daily Mortgage Rates Live with the Mortgage Calculator. Everybody take care.
Thanks, everybody.